Okay, it's 7:30. Andy, are you still there? Okay, no worries.
Yes,
Oh, you're there. Okay. Okay, thank you very much. Andy's on leave today, so very kindly he has come in to help me just set things up. And I think you take your leave now. You can see the screen and you can hear me clearly.
yes.
Okay, great. Okay, so warm welcome to everybody. We are having our update today. The usual update that we have every couple of weeks. So let me start. We're starting at 7:30, and let's try and wrap things up maybe by about 8:30. Okay. All right. Please remember to your microphones are probably muted. Please ensure that your webcam is off. Any questions, please put them on the Q&A chat box, and I will try and answer them later. If you want to speak later, you can always unmute yourself later. Please do bear in mind any reference to performance, historical performance is no indication of future performance. Should you need any help with any of the things that I've discussed or will be discussing in this presentation, please seek the help of your financial advisor, whether it's in Singapore, FA Financial Alliance, or in Malaysia, FA Advisory. Okay. All right. It's been a very interesting couple of weeks for markets. As you know, markets haven't been doing very well. But let's just have a look. The last time we met was on August 25th, almost a month ago. And at that time, markets were roughly around here, the same same level that we are today. But between August last month until now, the markets had actually gone up and taken gone above the historical highs. And this is the S&P. I apologize, I forgot to put down here. This S&P 500 had actually taken out the previous highs, but did not manage to maintain it, and now has drifted back or fallen back to the levels that we saw a month ago. Okay, many of you who have been following me will be very familiar with how I chart out the probabilities of where I think the markets are going. So let me just review where I think the markets are going now at this particular point. Previously, I thought, or rather previously, I had attributed a 5% probability of the markets continuing to just go higher and higher and higher. That was again the minority view, or rather the minority probability. I've now actually shifted that to 0, okay, which is a bit of a daring call, so to say. But it seems to me that it's pretty clear from the technical perspective, from the fundamental perspective, that we are in a market which quite unlikely over the next 1-2 months it will probably go. I'll be extremely surprised if the markets can actually retake back the highs that we saw recently, at least over the next 2 months or even for the rest of the year, in the fourth quarter of the year. Okay, so I'll be extremely surprised. Okay, it will prove me wrong, but at this point, I'm forward enough to, or rather, I'm truthful enough to tell you I don't expect it at all to overtake that highs. Instead, I've attributed a higher probability of markets moving sideways. Previously, the probability attached was about 25% probability. I've increased that to about 40%. So I think there is a slightly higher probability now that markets may continue lower, but at the same time, it's not going to go all the way down. It's going to find what we call a consolidation range before moving higher. So I've attached a higher probability at 40% here compared to 25 the last time. The slight, or rather the probability of it going down has decreased slightly from 70% to 60%. It still remains the majority probability that I think the markets still have this downside bias to it. But when you take into account both path 2 and path 3, you will see that now basically it's either sideways or down, and they're almost matching. I mean, 60-40, 50-50, it's around there. Okay, so there's a slight tilt in my view towards market being a little bit more supported, and I'll explain later, compared to vis-a-vis maybe a month ago or 2 months ago when it was more clear cut that the expectation was market was probably going to go lower. Okay, and I'll explain later why that buoyancy in the market, why I think so. Part of the reason why I don't see the markets going up and taking out the highs of 3588, the recent highs, because from the technical perspective, it looks like a really clear cut. It's baked in that the markets are probably going to go lower from here. And I'll explain why. One of the things that we've seen, one of the patterns that we see in the market is this. The previous historical highs of 3393 here, right? That was taken out quite convincingly in a sense. Market tried to rally, but kind of spluttered and then after that declined. This move back even below the previous high, and this red line here represents the previous high, is really a very strong signal that the markets are weak. Okay, so the first indication that the markets are weak is basically the markets could not stay above the previous high, which is 3393, which was, if you call it from a technical perspective, previous resistance now supposed to be turned into a support. Okay, so that gave way. Then the second thing was the market then rebounded, and the markets really couldn't take out the previous high again, and then stopped here. It was a major resistance now, or rather it became a resistance, and then the market started to U-turn from there. This pattern is very common when it comes to a reversal. That means you break down below what we call the previous high, and then after you try and take out a major resistance, you can't, and then it starts moving down lower here. Add that together with what we are very familiar with, which is the highs now have created what we call a lower high. The first high was here, the second high was here. The low, it's like a lower low now, more or less, we're creating. So when you create two highs which are lower and two lows which are lower, you basically create a trend, and that is a downtrend. So from the technical perspective, I know over at least the next quarter itself, I think most technical charts, or technical analysis or chartists, you probably come across on the internet or you read about or on YouTube. I'll be surprised if anybody is very bullish over the next 2 or 3 months. I think the majority of them, if they look at the same chart, will probably come to the same conclusion that we are seeing some weakness at least over the next 2 or 3 months. Okay? So potentially what we could see is the S&P 500 actually start to slip lower. And more or less, when you look at it, if it's a 15 to 20% retracement from the top, technically speaking, it still constitutes a correction. It's not a major reversal. Okay, so but we're only talking about the next 2-3 months, right? So the next 2-3 months, probably another couple of 100 points down on the S&P, right? And the whole move from top to bottom, probably about 15 to 20% from that perspective. For the rest of the markets itself, we always say that the rest of the markets, Singapore, Asia, Europe, are probably still very highly correlated to the S&P. So if you see the S&P dropping another 10-odd%, it's highly likely that the rest of the global markets will also follow suit. Okay? History also suggests that there could be more downside, because the last time we saw a similar pattern like this was basically in 2018, where if you look here, the markets actually moved back above its historical high, failed to sustain that move, and then broke back below the previous historical high, and then after that went down 20% over the last quarter of 2018. This time around, we are seeing something similar, i.e. break above historical high, cannot sustain, broke below again the previous historical high. And again, if we are looking for a 20% decline, then it's somewhere roughly around 2,870, maybe around 3,000. Okay? But so far, the move has been about 1 month. So we still have about 2 months, I believe, and there's some fundamental reasoning behind why I think the next 2 months may also be quite weak for markets, and I'll explain later. But we could be looking at another 2 months move back down to about 2,870, maybe about 3,000 on the S&P 500. So historically also, we've seen something similar happen in the last quarter of 2018. We could be looking at something similar happening in the last quarter of 2020. From the bigger picture perspective, the path tree, the one where I've attributed a slightly higher probability that the markets may actually be reversing in a major U-turn. Well, that's got to do a lot with the fact that in the past 2 major tops, which is basically in the year 2000 and the year 2008, every time we see a major top, you'll see that the market actually does what we call a double top. You know, it tries almost 2 times to go above, or at least on the second try, to try and go above the previous peak, and then it fails, and then it creates what we call like a mountain, but 2 mountains, a double top. Okay, this time around it's similar. This chart hasn't been updated with the latest decline here, but you can imagine now it's much lower here. Okay, so we are seeing what we call a double top being created today in this current scenario, which is very similar to what we saw at the top of the 08 cycle and at the top of the 2000 cycle. Okay, many a times these kind of tops, they start off as correction. It's only with hindsight that when you look back, then you realize that actually that correction turned out to be a major turning point in the whole cycle. Okay, similarly today, it's very hard to say whether this double top is merely a correction or a turn in the cycle. Only with hindsight we'll be able to look back and confirm that. But what I want to say is we have to be very cautious, because we are at a point whereby the cycle has been very extended. It looks like a double top. It looks like we're in a situation where some fundamentals, technicals come together and say, you know, we have to be very careful about this situation. So that is why we still attribute the potential for the markets to actually decline in path 3, so to say, with a slightly more higher probability than path 2. Okay, so this is one of the key reasons here. You know, those of you who have followed whatever updates I've been giving over the past couple of months, you would realize that I've kind of highlighted key areas whereby our concerns lie. You know, recently the market's been falling for about 3 weeks, about Nasdaq about 4 weeks, and you see a lot of headlines, a bit of, you know, very noisy, very messy type of situation, whereby today is this reason, yesterday was another reason, tomorrow is going to be another reason. So all these headlines basically more or less encapsulates what are the reasons given why the market has been declining, so on and so forth. Of course, yesterday the most recent one is we've got the problems with the banks being exposed as having, you know, illegal transactions and so on and so forth. So a lot of banking shares got hit and so. Okay, but anyway, I just want to put together some of these headlines here and show you some of these headlines, those that I have been mentioning about over the past couple of months with respect to why we think that the downside risk still remains. Okay, so I'll just start off with one, the tech sell-off. Okay, the tech sell-off, you can relate it also to the general US markets itself, and it boils down to valuations. We've always said that valuations in the US, while we believe that, you know, tech stocks have a reason for being expensive, okay, because again, it's growth stocks. You have many reasons why. You can explain it away, or rather you can justify why tech stocks are higher, but there's always a price for something, and we felt, or we feel, that basically it may have just moved much higher than where it ought to be with respect to valuation. And we're seeing that in many commentaries itself also, where valuations, when compared to the earnings, expected earnings, EPS, earnings per share and stuff, you get headlines like this. This particular share itself, too expensive for too little growth. Zoom itself, impossible valuation. MasterCard at its peak, too expensive to buy now. Basically, it means that whatever earnings per share that is expected from that particular company itself, vis-a-vis how much is being valued at, it just doesn't gel. And therefore, valuations have just gone beyond what is expected. I mean, I've read one article which says that in order for markets to justify current valuations, earnings per share have to be at least 20-30%, growing at least 20-30% over the next couple of years, which is going to be quite tough. Okay, so there's a bit of a disconnect between earnings, expected earnings, and basically what is valuation. So now we're seeing probably an adjustment in valuation to try and make it more what we call realistic vis-a-vis that of earnings. Okay, we've also spoken of policy. I've always said that, you know, policy is going to be tough because especially for the Federal Reserve, you know, monetary interest rates are really at the lower bound. You know, they can print, but again, that has repercussions to it. Then there's fiscal policy, but fiscal policy is also being limited by the fact that many countries have a lot of very high debt to GDP ratio and stuff. So policy itself the lack of the ability to expand policy in the current environment will also lead to what we call a much slower economic growth because the inability to respond, so to say. So again, these things are now being mentioned, cropping up in some of these discussions here. Okay. Vaccine, I know some of you have, I know my view on the vaccine. I'm not too optimistic about the vaccine, although markets have been optimistic over the past couple of months. But again, now it seems that the worries about a vaccine have started to crop up. Worries with respect to, we've seen one or two clinical trials either being stopped or being delayed because there have been actually repercussions with respect to those who are testing it and so on and so forth. Okay, so basically, and also now we understand more thoroughly that actually having a vaccine discovering a vaccine isn't the major thing, because you may be discovering or you may discover a vaccine, but there's always that issue of manufacturing it. There's always the issue of who gets it first, and there's always the issue of trying to inoculate or trying to give the vaccination to 6 billion people worldwide. And many people place that basically in 2022, 2023, before you really can get about 70% of the world vaccinated. And that's what you need in order to keep COVID-19 at bay. Okay, so now people are starting to realize, yeah, I think the market's priced in most of the good news about the vaccine. Now we're going to face these challenges going ahead. Okay. Again, economic recovery, we've always said in the second half of the year, that's when the economic recovery, this real situation will emerge. And true enough, we are seeing a lot of companies now coming out to say we can't survive, we've opened, we've tried, and we're closing back down again, and so on. So many of the economic indicators have done what we call a V shape, but the V didn't go back all the way to February levels or February highs, and now it's starting to go sideways. Okay, so basically that is quite evident in most of the economic data that we're seeing. So it's stalling, so to say. Okay, the second wave now. I mean, some countries are going back into lockdown again, and some of them full lockdown. In fact, again, this is something we had expected. This is something I think the market may just be now realizing it. So there's this again expectation and what has been priced in. So that's why the market probably is a bit lower based on that. Okay. And again, policy, and the US is just making things worse. They can't get through the next fiscal stimulus, and the longer they wait, the worse it's going to become for the economy itself. Yeah, so these are all the things that it's not new. If there's anything that surprises me is it took the market so long to actually come to terms that actually these are issues which have been there all the while, but maybe focus was elsewhere. Market was overly bullish, and only now that the market is focusing on these things. But these things were things we were talking about for quite some time. Okay, so I mentioned earlier about the next 2 months, next quarter as being very challenging for the markets. So why this next quarter? Two things. One is the US elections on November 2nd. I've mentioned again this before. If Biden wins, it's going to be short-term negative, long-term positive. If Trump wins, it's going to be short-term positive, long-term negative. The reason being Trump benchmarks himself against the stock market, his performance. He will do everything as, for example, cut tax rates previously and so on and so forth, okay, to try and get the stock market up, even if it means raking up huge amount of debt for the United States. So debt to GDP in the US has really shot through the roof. But he doesn't care. What's important is to just prop up the stock market and by having tax cuts and so on and so forth. Okay? Biden is the opposite. So Biden basically, the proposal is basically to now increase the corporate tax from 23.8% back up to about 40%. Okay, so this in itself is sending some shivers across, of course, the corporate world, and also for individuals, for the rich earners especially. Sorry, not corporate tax, but top tax rates, okay, for capital gains. Sorry, my apologies. So this one is sending some shivers across investors, because anybody sitting on capital gains itself will now have to pay tax. But there's a bracket to be, you must cross a certain bracket before you pay in terms of capital gains. Okay? But looking back into history, there were two times where such capital gains were actually imposed. And what happened was there was an increase in the sale of stocks prior to the introduction of those capital gains, which makes sense. I mean, if I'm sitting on gains, if the new president comes in and starts taxing capital gains, I'm probably would want to sell now and clock in my gains before that happens. Okay, so those two instances in '86 and 2012, the so-called capital gains or the sales actually jumped. Sales means the selling of stocks actually jumped by double digits, 60% and 40%. Okay, so in this particular case, they've made the calculation. They said if Biden's tax rates or capital gains tax was implemented, we could see what we call stock sales relating to this capital gains could be about 45 to 50% increase in the capital gains sales, okay? Just in order to lock in the capital gains prior to the introduction of the tax. Okay? But again, like I mentioned, at the end of the day, when such a tax is introduced, while the stock market and even investors may not like it because it's taxing capital gains, you must understand that the government itself, the US government itself, earns revenue. And that's critical because it is now suffering from a very huge gap in terms of its fiscal deficit. Okay, so there, like I say, it's short-term pain for long-term gains. Okay. The second thing, which I think over the next 2-3 months, which is going to be quite telling for the US, is COVID. So again, the US has failed quite badly, in my view, to take advantage of its situation and turn things around because of both political reasons and I think also because of cultural reasons and such. And what I mean by that is that, you know, when you see polls like this, where 50% of people say they don't want to wear a mask, 24% of them says maybe sometimes I'll wear one if I go to the grocery, maybe if I feel like it, I'll do it. If I don't feel like it, I won't do it and such. So you have about 70% of people who either for political reasons, for reasons they believe it's my right not to do so based on the constitution, whatever the case is. Okay, it's going to be very difficult to clamp down and to eradicate COVID-19, or not even eradicate, to control COVID-19 if about 70% of the population just don't want to wear masks. Okay, and when you talk about vaccine, then there's a new issue, which is now we have previously what we call the anti-vaxxers, people who do not want to take vaccinations for their children and stuff. Now we have people who do not want to take the COVID-19 vaccination. And these are not small number of people. This is just a random poll, not a very large sample, but I think judging from what I read, judging from what I see on the videos and stuff like that, YouTube and so on, I think the numbers more or less could be here. And here it suggests that about 60% of the population in the US, even if there's a vaccine, may not want to take a vaccine. So again, how are you going to handle COVID-19 when you don't want to wear a mask and you don't want to take you want to take your vaccination? Okay, so COVID-19 could still be around and wreak havoc in the US for quite some time because of these reasons. And I think that's why as the winter comes towards the end of the year, so don't be surprised if we're going to see some numbers spiking again in the US to very high levels and such, death rates going up. I wish it won't, but again, it could happen because of this. So that's going to impact on sentiment. And again, that's why we think over the next 2 months, the presidential election situation and the COVID situation may just come together to keep market really on the back foot, over the next 2 months. But there's good news, okay, and this is one of the reasons why I've shifted a little bit more probability to the second path. And the fact of the matter is liquidity still remains ample and by the sideline. Looking both in the European situation, where the liquidity amount has as you can see from the chart, shot through the roof. Similarly, in the US, when you talk about deposits in commercial banks, when you talk about money markets, money in money market funds, the charts are all quite similar. That means after March, it just goes up like this. What it means is that there's a lot of money sitting by the sidelines, and this money could be deployed back either into the stock markets or other markets when confidence comes back into the picture. And sometimes it's not just about confidence, sometimes it's also about desperation. And what do I mean by that? The Federal Reserve's ability to convince people, and they come up to say, we're going to keep rates lower for longer. So if you're holding on to a bond, for example, don't expect a lot of returns from bonds because rates are going to be very low. So this has really frightened a lot of pension funds, a lot of institutions, lifers are life insurance companies, because they have traditionally put the majority of their holdings in bonds. And if bonds can't give them that returns over the next couple of years, where are they going to get their money from? So it could be a point, we could reach a point whereby, as much as they may not like to do so, we could see, and we are actually seeing news coming out of pension funds, lifers, even sovereign wealth funds and stuff like that, okay, taking on more risks because they can't find returns with traditional bonds or where they traditionally have been, okay. And when you look at the headlines, it's true. These are some pension funds, and of course, these are some of these are smaller pension funds, like Texan Employee Pension Fund, 0.3% return, trails a return, 1.1% below benchmark, 1. I mean, because bonds don't give a lot, so it's no surprise if you see pension funds with the majority of 70-80% in bonds earning about 1%, maximum 2%, and so on and so forth. Okay, so basically, what will happen is that even you see, for example, the Norway Wealth Fund, they themselves are saying, let's go and invest in North America equities because the US is doing well, which is, in my view, lack of a better word, it's like crazy. I mean, it's like the valuations in North America are just so high. Why do you still want to go there? But it just tells you that maybe it's desperation. Okay, so desperation could push some of these funds into the equity markets when the equity markets decline, thus putting a floor to the equity markets. Okay, another thing that's helping is that, of course, we have a market which is a lot of derivatives and such, and most recently this chart is quite interesting. There are a lot of shorts now on the Nasdaq, higher since 2008, and you can see from this particular chart itself, it just is quite large compared to historical levels or historical shorts. This in itself basically will help the market find a floor, because if you are short, you need to cover your shorts at a certain point in order to basically buy back and cover your position. And if you're looking for the markets to typically drop about 20%, then today you're going to hang on to your shorts. As the Nasdaq, as the S&P arrives basically at a -15, -20% decline, that's when you start coming in, because technically that's where you expect the market to bottom. Okay, so then naturally will provide some of support for the markets. All right. So just to have our view kind of in summary, over the next 2 to 3 months towards year end, I think the markets may start to drift lower. All right, we've seen quite a sharp decline. We could continue to see a decline. Whether it's going to be sharp or not, I mean, I think roughly we're going to head towards 3,000, 2008 maybe on the Nasdaq. Like I mentioned, 15 to 20%, or not Nasdaq but S&P, but top to bottom maybe about 15 to 20% decline. Okay. Of course, the big question now is when we enter 2021, where are markets going to head? It's going to depend very much on the situation then. Right now we can only just make a guess. So my guesstimate basically right now is that we probably will see a path somewhere in between those two arrows. Okay? I think the markets still continue, as I mentioned, to have slightly higher probability to the downside, but slightly more probability that it's going to move sideways from where we are today. Okay, so that's my projection for the markets going at least to the next 3 months, potentially a year after that. Okay, I want to just answer 2 questions which potentially could crop up later in the FAQ, or rather, sorry, in the Q&A. But I'll answer them now with a few charts. The first question relates to the dollar. The dollar has actually started to go up, at least in September. If you look at the dollar index itself, it's risen from a low here all the way up here in September. So some people have started to ask me, is the dollar going to strengthen from here and so on? Our view remains that the dollar should by right continue to move lower given the myriad of situations, for example, low interest rates, large amount of quantitative easing, the fact that the US needs a weaker dollar, although officially they've not said it, they need a weaker dollar to complement both their fiscal policy and monetary policy. So all these add together, tells us that basically a weaker dollar or lower dollar is basically what is in store over the long run. These kind of rebounds over the short run is to be expected because nothing goes down in a straight line. It becomes a bit more evident when you look at it from a bigger perspective, and this is a multi-year chart since 1990. We are here today. The dollar seems to be right in the middle of this kind of really long-term range that we have. We won't be surprised if the dollar continues to head lower to the lower end of the range, so to say, given all the situation that we mentioned. Okay. Not only is the fundamental of the US dollar suggesting a weaker dollar, i.e. low rates, quantitative easing, and so on and so forth, but we're beginning to hear, and this has been ongoing, it's more structural in nature, but this kind of talk has been surfacing, and this is the de-dollarization talk, which is the world is trying to move away from the US dollar. The last time the major shift we saw was basically a few years ago when Russia itself basically dumped almost every single US Treasury it had in its reserves, and it actually replaced it with gold. I don't have the chart here, but it replaced it with gold. But if you can see here, Russia actually sold its US Treasuries. Basically, countries have US dollars. Countries like Russia have US dollars because these are petroleum dollars. Russia is an exporter of petroleum. When they earn US dollars, because US dollars petroleum is paid in US dollars, they don't keep US dollars per se. What they do is they convert it into US Treasuries. Okay, but as you can see, either for political reason and also for trying to move away from what we call dollar dominance, Russia has done so. Very interestingly, China, Global Times is basically a newspaper in China which is state-backed, i.e. it is probably the mouthpiece of Beijing. Many people say that. They actually, in this trade war situation, have kind of warned the US, we don't think that we do not dare to sell your US Treasuries because we hold the second largest holder of US Treasuries. Don't think that we do not dare to sell, we dare to sell US Treasuries. Okay, so don't play around with us and so on. Okay. And also China, as we know now, in quite a lot of deals that we've heard of, are not using US dollars really. It's either using the Chinese yuan or other currencies based on who they're trading with. Okay, so this de-dollarization itself is also one reason why maybe it's more structural in nature, but it's also one reason why sentiment on the dollar may be a little bit weak. Okay. One thing that we need to look out for also is potential move out from the US, because where US stocks are concerned, they still remain very, very highly valued, okay, in terms of valuation. So therefore, any move out from the US, rebalancing, switching out into better value emerging markets, better value European equities, and so on and so forth, would actually entail a weaker dollar because you basically have to sell dollars and buy emerging market currencies or euro in order to invest. So that in itself would also lead to a weaker dollar going forward. Okay, so this is something which again, these things are cropping up. People are writing about it, as you can see the headlines and so on. Right. I also want to touch on gold because for those of you who have followed me over the past couple of months, you know I've been bullish on gold. I continue to be bullish on gold, but recently gold has seen a bit of a retracement. So I just wanted to update everybody who has been following my views on what's happening. Okay, we've spoken about the weaker dollar, so that I think is a trend. So currently, over the past month, the dollar has strengthened. I showed you just now, and when the dollar strengthens, gold of course gets hit a bit, right? But if we continue to see the dollar on a downward trend, then sooner or later you will see gold revert back, dollar go down, gold start to go up. Okay, and that's evident in the chart where if it's a long-term chart, there is this correlation you see, although not one-to-one. But you can tell that there is this correlation where the dollar and gold goes in opposite direction. Okay, so as the dollar goes down, expect gold to go up. Okay. More importantly, in fact, is developments over the past month or so in Jackson Hole, where the Federal Reserve has an annual meeting. they announced a new framework for their monetary policy. Their framework for monetary policy is basically inflation targeting 2% inflation. What they've done is they have now actually changed, or rather they've modified it to say that we will allow inflation to exceed 2% because we're not looking at the nominal number of 2% target. We are now looking at an average target, meaning to say that if inflation over the past year had been 1%, this year I'm able to allow inflation to go to 3% because why? 1 plus 3 divided by 2 years equals to 2%. So the average inflation of 2% is what I'm looking for. It's not the actual nominal 2% target I'm looking for. What that means is the Fed will now tolerate higher inflation because it's allowing inflation to move above 2%. Okay, so again, everybody, it's very clear. Even the Fed has said to the market straight in the face, we will allow for higher inflation. Okay. At the same time, they say we will keep, and I think this is well telegraphed to the markets, we will keep interest rates as low for as long as possible, potentially 2023, even 2024. Okay. So when you have a situation where interest rates are kept low for an indefinite period of time, and you allow and you try and engineer higher than normal inflation, what you're going to get is you're going to get real interest rates going into deep negative. Because as we know, and you look at this equation here, real interest rates basically is nominal interest rates. There's a more complicated formula here, but the rule of thumb formula is below here. So nominal interest rates minus inflation. So if inflation is allowed to go to 3, maybe even 4%, and nominal rates are kept at almost 0, what you're going to see is you're going to see real interest rates go from -1 to -2 to -3 to -4. Okay. We all know that real interest rates and gold have this really very strong negative correlation with one another. If you look at this chart, this is a chart of gold and real interest rates on an inverse basis, on a negative correlation basis, okay? And they move almost in lockstep. So on this y-axis on the right-hand side, this is basically something called the 20-year TIPS. It reflects what we call real interest rates. If real interest rates now are allowed to go to -1, -2, -3, -4, then automatically gold will just move up in tandem based on this correlation. So that's what, and that is why increasingly more and more investment banks and such, Bank of America is seeing gold prices higher. Most recently, we have UBS also looking for gold to move much higher. Okay. The short-term volatility that we're seeing in gold, and especially in gold mining stocks, is related to Nasdaq, or it's related to Nasdaq and it's related to the US stock market. My own theory or thesis is that we've gotten the gold market, especially the gold mining stocks, have gotten a lot of participation from the Robinhood crowd. Because when you look at the correlation, and this is a correlation between the Hui index, which is the gold bar index, which is the one in the candlestick colored one. The blue one is the one which is Nasdaq. And they move in lockstep over a short period. And this is really a 5-minute chart. It's sometimes a bit baffling when you look at it and say, what has gold mining companies got to do with technology companies? I mean, there's two different things altogether. They shouldn't be moving in the same direction, especially with such a high correlation. Okay, but when you understand that basically if you're a day trader, if you're a Robinhood trader, and you are trading both the Nasdaq and both the gold markets, gold mining companies, then you sell one, you sell the other. You buy one, you buy the other, and so on. So that results in the high correlation. I don't expect this to last, but this is just trying to tell you that basically some of the volatility that we see in gold today is because of this speculation from the so-called Robinhood crowd. Okay. I'm going to end my session by leaving you with a story which I came across in Twitter, which I found very interesting, and I would like to share with you. This is a story about Soros, and we all know George Soros and Druckenmiller. Druckenmiller and Soros are two of the best hedge fund managers in the world throughout history. Okay, both of them worked for this fund named Quantum Fund from 1999 to 2002. So you had two of the rival They work in the same company, but more or less within the same company, they were rivals. Okay, Druckenmiller and Soros. Soros, of course, is a little bit more, I would say, is a bit more typical hedge fund, kind of naughty guy who goes and shorts the British pound, go and short the ringgit and Thai baht and stuff like that. Okay, Druckenmiller is a bit longer term type of guy. Okay, anyway, so when they both of them see the Nasdaq, what they do is basically in that company itself, they will present their views to a group of big investors, and these are big investors who will not put millions, but sometimes put billions of dollars with quantum fund. So if they're successful, basically the investor will buy their story and put money with them. Okay, and so basically Soros has always been that iconic. Of course, he's older, so he's been that iconic hedge fund manager who has managed to break the Bank of England, who's managed to break Bank of Thailand, Bank Negara, Bank of Indonesia, and stuff like that. So he's very famous. So a lot of people tend to follow him a lot. Okay, so during this Nasdaq increase here, Soros became quite skeptical of the Nasdaq.com rise. So he started to actually short the market, and the red color arrows are him shorting the market. Okay, this one I didn't put exact dates. I'm just telling you roughly visually he's shorting the market, and he shorts the market more and more as it increases. So he doubles up on his position. Market goes higher, he shorts double. Market goes higher, even short even more. Market goes higher, even shorts even more. And that's why the arrows become bigger and bigger and bigger. Okay. Whereas Druckenmiller believes that the tech market or the tech stocks are the future, and he goes long on the stocks. Okay. And at the beginning, what happens is many people, because they follow Soros, they are with him, they follow his strategy, they put money with him, so they actually start to lose money because as you're short and the market goes up, you lose money. All right. And then what happens is this group of investors who have put, and this is the majority of investors who have put money with Soros, they basically then, after a couple of months and looking at their losses, they made about 40% loss, 50% loss. They start to move money over to Druckenmiller. Because why? Over the past 4 or 5 months, Druckenmiller has done well. He's gone long with the market. So basically, the majority of them have moved most of their money over to Druckenmiller near the top of the market. So at the top of the market, the majority of people abandon Soros, moves over to Druckenmiller, and guess what? After that, the market just falls, and these guys, having lost 30-40% with Soros, moves over to Druckenmiller at the top of the market, and then after that, the market falls, and then they panic and they lose money, and then after losing another 20-30% of their capital, they bail out. So they've lost both on the upside when they were with Soros, and they lost both on the downside when they were with Druckenmiller. What happened to Druckenmiller? Druckenmiller, because of his long-term view of the markets, continued to buy the markets, even though the markets were declining like a rock. He continued to buy, he continued to buy, he continued to buy, he continued to buy. And lo and behold, after a few years, he stopped buying somewhere around 2003. After a few years, he actually got out of his position with profit, without a loss. Because while he bought all the way up and all the way down, when you average it out, okay, it's not that bad because you're buying both sides up and down. Okay, so it evens out. Okay, and then he got out with a profit. The moral of the story is, and they termed it, and this is not my saying, they said this is a good example where the bulls make money, which is Druckenmiller. The bears make money, which is Soros, but the pigs get slaughtered, which is the investor who are fickle-minded, went in with Soros, got out at the top, went in with Druckenmiller, suffered the whole decline, lost 40% this side, lost 40% that side, and basically lost 80% overall and such. Okay? So the moral of the story is this. Both Druckenmiller and Soros had a view. Their views were right, except that their views took time to unfold. Okay? Why I'm bringing this up is because, for example, with respect to gold itself, when I look at the fundamentals of gold, and I talk to you about things like real interest rates, when I talk to you about quantitative easing, inflation, and stuff, the fundamentals, in my view, are there. Okay? So it's just a question of when this whole thing unfolds. in that journey towards this thing unfolding, you will find these kind of situations which you've encountered, for those of you who may have gone into gold and such, where there are the 15, 20, 30%, sometimes even declines and volatility. That's part and parcel of investing in something with high risk, high volatility, because you're looking for high returns. Okay, so that goes hand in hand. You need the 30% volatility in order to make the 60% gain. That's quite common, right? The most important thing is that the story still has to be intact, and the story has to be a valid story. And I'm telling you that the gold story, in my view, is a solid story. It's just that unfortunately it comes with the volatility. Okay, so for those of you who have a position, who are potentially sitting in a position, maybe loss making and such, as long as you ride out the volatility, I think in my view, there's no reason why you can't reap the rewards going forward into the future. All right. All right. Thank you very much. I'm done with the presentation. I think good time, about 45 minutes. I'm going to stop my sharing here and slides here, and I'm going to open this up for Q&A. I see two questions already on the chat box. I'm going to take that up first. First question is, what's your view on the trade war after US presidential election if Biden wins and if Trump wins? Will it be resolved? My view is yes, it will be resolved. And the reason being is, okay, for Trump itself, he needs to play up this trade war because it's what my view again, is what his voters want to see, a tough guy standing up to China and so on and so forth. Okay? But I think Trump also knows that in order to bring the economy back on its footing, or at least in the situation where there's COVID-19 and the economy is suffering, you really need China to come in to buy your soybeans, to buy your agriculture, to buy your products, to buy your minerals, your metals and stuff, because otherwise you're dead. All right. So, and I think China, vice versa, also realizes that. Okay, but China again also doesn't want to be seen as kowtowing to the US and stuff. So, from the economic perspective, I think there could be a reconciliation after the election, because you need to look tough before the election, but after the election, I think that thing can be solved. With Biden itself, I think he's taken also what we call a little bit more of aggressive stance. When he was with Obama the last time, they tend to take the normal stance where don't aggravate situation with China and so on and so forth. China, you can close a little bit of one eye if China does something and stuff like that. But I think now it's like, because he knows the voters want a tougher stance. So I think he will take a tougher stance. But at the end of the day, I think it still falls back to what I've just mentioned. If Trump wins, which is either president will know that they need to at least work hand in hand to try and get some trade through. Otherwise, it's a lose-lose situation for both. Okay. Would a weaker dollar? Okay. Second question is: would a weaker dollar actually be a boon for U.S. equities? The weaker dollar itself. So, in many ways to look at it. If you look at it from a weaker dollar helping US corporations become competitive, therefore revenues increase, then you could say it's actually it could be a boon for US equities. But that really is via a few linkages. Weaker exports will be more competitive, then the revenue of the company increases, and then you get earnings per share, so on, so on. Okay. But the more direct impact would be a weaker dollar actually will impact investors who are investing from outside into the US, because we're talking about forex risks. Okay? One thing which a lot of international investors have benefited is not only the capital gains over the past couple of years from the US markets, but also the firm dollar, at least stable dollar, but firm dollar in many cases, that's actually added on to the gains that they've made on Wall Street, whether it's Nasdaq or S&P and stuff. Okay, so basically, a weak dollar, if you look at it from this more direct point of view, could actually impact sentiment, especially for people who are investing into the US from outside, and there are a lot of them. because you can imagine past couple of years, the US market has been one of the few markets which have been doing well. So a lot of international money has flowed into Wall Street, onto Wall Street. Should we use TIPS ETF to ride the hike in inflation or inflation? Yeah, you could. For those of you who don't know, TIPS are basically a type of bonds where the rates are adjusted to take care of inflation. So nowadays, if you're going to buy a bond, and if you can, typically, and TIPS are not easy to find here. I think it's more in the US. People tend to buy TIPS, Treasury inflation protected securities. Okay, so it's actually, it protects your bonds because it adjusts for inflation. Yeah, so that is basically one strategy to counter inflation. Yeah, one strategy to counter inflation. Okay. All right. Any more questions today? Got 3 so far. Okay, so one more question. There's 4 questions. Sorry. What about your view on Asia markets and emerging markets moving forward? All right. Valuations on emerging markets, especially that of Asia, excuse me, of course, relative to the US, is very attractive. Europe and Asia, actually Europe is quite attractive even relative to Asia, because Europe has come off quite a bit. But let's focus on Asia. So Asia itself, basically, there is really a lot of people who are looking to Asia. The only problem I have with Asia is not Asia itself, is the fact that it is still correlated to the US markets. Okay? So what we have today is US valuations are here. Asian valuations or emerging market valuations are here. Okay? Because of the correlation that they have, I don't think it's 100% safe enough to just argue that it's safe to go into emerging market valuations, Asia valuations. If the US falls, Asia will not fall that much because valuations are already so low. I don't think that's the case. I think if the US falls, Asia will also fall. And you can see it yourself most of the time when overnight the Dow Jones or Wall Street falls, next day Asia markets also tumble and so on. Okay. So what I would say is this: when the US declines and Asia declines one notch down together with the US, I think that's when you go into Asia. And when you go into Asia, you lock in what we call the high dividend paying stocks. Okay, because these are the guys whom, when you want to play the dividend game, you let's say, for example, I give you an example. I met a lady once who was holding on to this stock, and I'll tell you the stock name because it's just a story. Public Bank in Malaysia, and she's been holding on to it for the past 20 years. and when I spoke to her, she said, I'm never ever going to let go of it. Because why? Because when I bought it, it was like just a couple of dollars, couple of ringgit at the time. And so then the dividend yield that she's locked in is just tremendous. And it works for REITs. For example, if you can find a REIT, of course you must be very selective, not the type of REITs which, retail and stuff, which may be facing problems. But let's say you manage to find a REIT which gives you a very steady dividend. Once you buy it at a low price, you are effectively locking it in that dividend yield. Okay, because when the price goes up already, or goes up in future, well, you've bought it at $1, pays a dividend of 5 cents, or pays a 5 cents dividend, so you've locked in at 5%. Next time, a year from now, your cost is still $1. You're collecting your 555. The share price may go up to 2, 3, 4, 5. The next person who comes in and buys it at $2 with a 5 cent now only gets 2.5 cent, 2.5% dividend, much lower. The guy who comes in at $5 collects a 5 cents dividend, only gets 1%. So you see, once you lock in shares or dividend paying shares or whatever the case is at a very good price and hang on to it, I think that's a good strategy. Okay. And you can still find some of these guys in Asia who pay quite consistent and quite high dividends. So yeah. The REIT sector, okay, I don't profess to be a specialist in the REIT sector. We have a specialist in the REIT sector. His name is Henry Loh. Please do look at some of his videos. I think it's available. Okay, but what I'll say is basically be selective. Again, REITs. When I speak to Kenny, Kenny is quite bullish on, very selectively bullish on certain REITs. Okay, I'll approach it a bit more on the macro side because that's my area of expertise. REITs tend to be they tend to play on leverage. All right, we are in a deleveraging environment. Going for REITs which probably have maybe slightly less leverage, in my view, okay, which are of course in sectors which are a little bit more immune to what we're seeing in COVID-19 and so on and so forth. But there's always a price for something. So as bad as, for example, as bad as a mall REIT is, when it reaches a certain price, it could actually be attractive, despite the fact that we don't have a very good view of. You may think that a mall may not do well over the next couple of years, but if you really get an operator who can think outside of the box and then redo the mall again into something which is, can generate returns, who knows? You just bought into the next thing. I can always imagine, like for example, there are a lot of warehouses in Singapore for the past 20 years have been used as places to store goods and stuff. But nowadays, when I look at the warehouses, what do they do with it? These guys come and buy these warehouses, redo the whole thing, and then subdivide it into what we call storage come workplace. Storage come workplace. Okay, there's actually a company called Work and Store, Work plus Store. Okay, who do they target? They target e-commerce people, because even if you're doing e-commerce, you need a place to put your inventory, and you need a place to work. Okay, so it's like a room where there's a window, because you're going to work there. You need a window, which is much better, and then you have a place to store. So they've evolved from just purely last time, kind of like rundown storage place, and they've evolved now to create this kind of small storage for e-commerce. So maybe if you can find something like that, and the REIT operator is smart enough to change some of these retail complexes or retail outlets to cater to what's the next thing, then why not? Yeah. Sorry if I couldn't answer you in more direct about the REIT. That we have an expert on it. Please ask your consultant, and he'll be able to refer to some of the videos and our thinking. All right. Any other question? Probably take one last question before we end. We're coming up to about an hour. I think it's a good time. It's good timing. We'll try and hold a few more of this as usual. A couple of weeks, every month, probably about one time, we'll hold an update to keep you updated. Sorry, I think I just. Okay, we got another 3 questions. Okay, we'll take the 3 questions and then we'll end after this. All right. As many things are probably factored in, what are the other hidden catalysts that might affect the markets? Well, good question. I'm wondering whether you're referring to positive catalysts or negative catalysts. One of the things that we've always worried about is skeletons in the closet. Skeletons in the closet, basically, as the name implies, are things that you don't know about. It just suddenly pops out from the closet. We've seen those things come up in both crises in 2000 and 2008. In the year 2000, it was a dot-com crisis, and basically it was focused on tech shares. But what followed suit was basically we had the corporate scandals, Arthur Andersen, Enron, WorldCom. You must understand that when a cycle turns, especially after a really good run up, like what we are experiencing now, a lot of things get hidden and a lot of things start to pop up. Like for example, TransferWire in Germany. So there are already corporate scandals popping up here and there in Singapore and rest of the world because of the go down and because what COVID has done. So these are skeletons in the closet. I would not be surprised if more skeletons come out from the closet, and that would actually be the hidden catalyst. Um, um, even the banks and stuff like that, even sovereigns. Now there's even talk about some emerging markets like Turkey potentially being in trouble and stuff like that. So a lot of time these things are not very visible when things are doing well, but when things don't do well, you start to see all these risks cropping up. So if you ask me, are there more positive risks or negative risks? I'm telling you straight away, there are more negative hidden catalyst risks out there. And that also results in me seeing a little bit more downside to the market. Okay. If we hold tech-related unit trust, should we start selling? Um, it really depends on it really it's not an easy question because it really depends on the individual. We always tell our clients, you ought to have two buckets: the short-term bucket and the long-term bucket. The long-term bucket is driven by financial objectives, retirement, child education, paying off your loans, and so on. This is something which, regardless of where the market is, where the cycle is, if your timing of your financial objective is 10 years away, then you ought to actually see through that objective. But if you are parked or you're investing using your first bucket, and your first bucket is your speculative bucket, your trading bucket, and so on and so forth, then of course this is your in and out bucket. Okay. So we always tell clients, the worst thing that you can do is to mingle these two things, and you're not sure what it is. Your child education, your retirement fund is co-mingled in this bucket where you are trading the market. That is extremely dangerous because you may lose everything, as you know, in the stock market. So you always segregate it, and that's why when you ask me whether we should start selling, if you're in the first bucket, I will sell. But if you're in the second bucket, like I say, probably you have an objective to reach, then you ride through the cycle. That's not an issue at all. Okay. You may want to lower some of your risk by switching a little bit out into bonds and stuff. You can do that. I mean, this is called rebalancing and stuff like that because tech has gone up so much. You may want to rebalance it again, but you don't typically switch totally out because of that. Okay. So I want to get rid of my WhatsApp. Okay, what bond is good now? No bond is good now. No, I'm just kidding. Bonds, as the pension fund article show you, it's a difficult instrument to make money today because interest rates are already very low. You only make money from bonds either from three things. One, from the coupons or the yield, and yields are very low. Two, from capital gains. When interest rates go down, bond prices go up. Interest rates are already near the floor, so you don't have a lot of downside on interest rates in order to have capital gains. Three, currency gains. That means this entails that you go out and invest in rupiah bond or US dollar bond, whatever, to try and play the currency, which is again a difficult question because then you need to have a view on the currency. Okay? So to us, it's going to be difficult to make money on a bond. So if you really want to try and let's say, for example, you're conservative, and then you say, wow, if I'm going to put everything in a bond, I'm just not going to go anywhere like the pension funds. Rather than move into equities and take on too much risk, we would say, why don't you carve out a little bit of your bond portfolio, say 90% bond, 10% equity. Okay, and take a view on that equity. For example, gold miners and stuff. Take a view. It's going to be volatile, never mind. But you got 90% in bonds and you got 10% in this volatile equity. We've done the numbers before. And we think that this strategy itself is probably a very good strategy. It doesn't entail taking on too much risk, but you just have to hold it for a certain period of time. I'm not sure who your consultant is. Please go to your consultant, ask him or her to show you one of our fact sheets where we have put a 90% bond plus a 10% gold unit trust together. And this thing is yielding really good returns, like 5, 6, 7% because gold has been doing well. Okay, and with quite minimal downside. Yeah, so please do approach your consultant to show you and explain to you a little bit more about this 90-10 strategy. Okay. Question is it okay to invest in unit trust despite US markets at high valuation and believing that US markets will correct lower? When you talk about global unit trust, then again, my question is, what is your time horizon? Because of our view that the markets may be a bit more biased to the downside, when we talk about equity unit trust, we prefer that our clients go in a dollar cost averaging. So to give you an example, since we think that the markets are going to at least go down for the next 3 months, potentially over the next 1 year, after that in 2021, maybe even drift a bit lower, then what we have is a market recovery portfolio where we ask clients for the next 18 to 24 months, you break up your investment and you go in a dollar cost averaging. That's our and that is a portfolio that we're running. Your consultant will be able to explain a bit more what the portfolio is all about, what we put into the portfolio. But that is the strategy. Don't go in lump sum now unless your view is really strong view that market's going up. But if you have a view like us, then safer is to break it up into dollar cost averaging. Okay. Next question is last question is global bond or short duration bond good to hold for another year? We are in short duration bonds. We think that is the safest part of the bond market. Why are we there? When we talk about bonds in our portfolio, typically it caters to the lower conservative investor. So we feel that if you are a conservative investor, we don't want to take too much risk. We will put you in a short duration bond. We think that it is a period of time where not losing money is making money. There is a time where not making money is losing money, and that was the past 5, 6 years. Okay, but we've moved into a period of time where not losing money is making money, and therefore short duration bonds are more safer than global bonds. Global bonds will give you much more return than short duration bond, but we think that basically the risk reward may be a little bit skewed to the riskier side for that. I say that because interest rates are low. Okay, no one expects interest rates to go up. And yet central banks are trying very hard to ignite inflation. For some strange reason, if they succeed over this short period of time and inflation starts to spike, your bond market will collapse because your bond market will start to incorporate higher interest rates into expectation. And as we all know, higher rates results in bond prices going down. And because your bonds are priced at such a low interest rates, the duration risk is extremely high. What do I mean by that? When interest rates are at 1%, i.e. now currently, when interest rates move to 2%, which is not a lot, from 1 to 2 is basically not a lot, but you must remember when you're holding a bond which is 1% and it goes to 2% and rates go to 2%, 1 to 2 is 100% increase. When you use that in a bond calculation, I apologize for being technical and stuff, but when you put that into a bond calculator, I'll just give you an example. If you are holding on to a German 30-year bond, currently at 0 interest rates, if interest rates go up by 1%, 30-year, that means long duration risk, your bond will go down by 30%. You know, that's the reality of it because rates are just so low. It's different when you tell me or I tell you that we are holding on to a Malaysian bond at 5%. The risk is the Malaysian bond will go from 5% to 10%. Then you lose 30% of your value. But the probability of the bond going from 5% to 10%, doubling of the interest rate, it's not very high. So that probability of losing 30% of value of that bond also not very high because of that situation. But now we're talking about a bond going from 1 to 2, which is high probability of happening. And so there's a high probability of losing money if that happens. Yeah. So the bond duration doesn't care whether it's from 1 to 2 and 5 to 10. All it knows is that the sensitivity knows is that it's 100% increase. Okay. I apologize. It's a bit technical, but that's how it is. So you need to be a bit careful when you are investing in bonds. If you're holding on to a single bond until maturity, then you don't have this risk. because upon maturity, you're going to get back principal. Okay, so the only risk you hold is basically the issuer risk, the risk of the issuer going bankrupt and stuff, but you don't have interest rate risk because bonds that are held to maturity, you get back your principal. You don't sell of course, you don't sell midway lah. Yeah, so that's the only safe part of a bond if you're investing in a bond. All right. Okay, so I think I've answered everybody more or less. Good amount of questions. Thank you very much. If there are any outstanding questions which I may not have answered, or if you need some clarification, please do approach your consultant. He or she will be more than happy to forward your question to me, and I'll be able to answer. Okay. Otherwise, I would like again to thank everybody very much for tuning in, listening to me for the past hour. Hope to see you again in the next update. Take care and stay safe and have a good evening. Thank you.